Hi everyone. I guess you're all doing okay. I guess you're all doing good. So we're gonna focus on the cash flow. We're gonna do 5.2 and 5.3 cash flow. This is N4. This is N4 financial accounting question paper 2023 June. So we'll be dealing with the 5.2 and 5.3 for now, and then the 5.2, it requires us to do the note for cash received from customers, whereby the note from cash received from customers, you take your revenue, you add with your trade receivable at the beginning, you less with the trade receivable at the end. So what you're gonna do now, we're gonna key in what? You're gonna key in amounts. So let's go and look for trade receivable at the beginning. So the trade and other receivable at the beginning. This is trade and other receivable. This is trade and other receivable, which is 2021 and 2020 and 2021. So 2020 is going to be what? 2020 is going to be at the beginning. 2021 is going to be at the end. So at the beginning, we have how much? We have 227,000. 227,500. And then at the end, trade at the end, we're gonna have what? We're gonna have 200,000. We're gonna have 200,000. 200,000. This is what I'm talking about. This is 200 at the beginning. This is 227,500 at the beginning. This is what? This is 200, and this 200,000 is the trade receivable at the end. And then we're gonna key in revenue. The revenue, we're gonna get it go income statement. This is our revenue. This is our revenue. So our revenue is how much? Is 4,200,000. This is our revenue. So the trade and other receivable at the end is going to be in the brackets. You less it, and then you're gonna get your total. If you say 4 million, if you say 4,200,000 plus 227,500 minus 200,000, you're gonna get what? You're gonna get your 4,227,500. So we are done with the note for cash received from customers. We're going to note for cash paid to suppliers and employees. So here we'll need to know the structure. You'll need to know the structure. You'll need to know your structure. So if you know your structure, then you can be capable enough to get it correct. So when we prepare the cash paid to suppliers, the first thing that you're going to do is to key in amount of the revenue. The revenue must be in the brackets. We're gonna go to the net profit. We're gonna go to the expenses for the year. We take the adjustments, which is interest on bank overdraft, interest on mortgage bond. So when you combine them, they give you the interest expense. So we're just supposed to write interest expense, but unfortunately we are given two interests, whereby it's interest on bank overdraft and interest on mortgage bond. We're gonna have the interest received is also. We're gonna have depreciation. We're gonna have the profit on vehicles sold. We're gonna have the inventory at the beginning. You add, you less inventory at the end. you less trade receivable at the beginning, you add trade payable at the end. So this is your structure. Your structure will look like this. So when we key amounts, when we have our revenue is 4,200,000. This must be in the brackets. And then when we go up, we're looking for what? We are looking for the net profit for the year. So our net profit for the year is this one. This is our net profit for the year. The total comprehensive income for the year. So we are preparing the cash flow for 2021, meaning we're gonna take this 383,500. We're gonna take this one. It's going to be positive, 383,500. And then how are we going to get the expenses for the year? You take the revenue, you add with the net profit for the year. 4,200,000. It's a negative, don't forget it's a negative 4,200,000. And then when you say plus 383,500, it gives you negative in the brackets, negative 3,816,500. That's how it's going to give you. So when we go to our adjustments, we're gonna key in interest on bank overdraft, interest on mortgage bond. This is at the interest paid. So the interest on bank overdraft and the interest on loan. The interest on bank overdraft and the interest on mortgage bond. Let's go and look for them. Let's see, where are they? This is the interest on bank overdraft, which is 1,200. 1,200. So when it comes to the cash paid to the suppliers, the incomes are in the brackets, the expenses are not in the brackets. So here the interest on bank overdraft, it's an expense, don't be in the brackets. Interest on mortgage bond, it's an expense, don't be in the brackets. Interest received, it's an income, is going to be in the brackets. Depreciation, it's an expense, don't be in the brackets. Profit on vehicle sold, it's an what? It's an income, is going to be in the brackets. So the incomes are in the brackets, the expenses are not in the brackets. So interest on mortgage bond. So the interest on the mortgage bond, this is the interest on mortgage bond, 166,500. This key, 166,500. We are moving. So let's go to interest received. So we know the interest received, we only received the interest when we did what? When we made the investment. So when we made the investment, we're going to have what? The interest. So here they are telling us that the interest on fixed deposit, and then there's a question mark, we'll need to calculate it. So they are telling us that the investment here, they are telling us that the investment was made on the last day of December. On the last day of what? December. On the last day of December 2020. And then our financial period ends when? On 30 June 2021. 30 June 2021. Let's get it. So what we will need to know, we will need to understand the interest percentage and the amount that we invested. So let's go and look for the amount that we invested. So note 2, well, fixed deposit. What is this? Allied Bank, 18%, 25,000. So our financial period ends when? June, Our financial period ends June, and then we made the fixed deposit when we made the investment when on the last day of December, ne? Yes. So we're gonna have what? We're gonna say what? We're gonna say 25,000 rand multiply by 18 over 100, and then multiply by, let's count the months. So it was made when Kadite 200 December, so it's going to be active on the next month. Since well, let's say 31 here, it's going to be active on the next month. So when we count, we don't count December because of it was made on the last day of December. So it's going to be active on the next month, which is January. So it's going to be January, February, March, April, May, June, which is 6 months. We're gonna say 6 over 12, and then when you punch this, it's going to give you what? It's going to give you 2,250. Ne? We're gonna key it here, 2,250. So this is an income. So don't forget what I've said about the incomes. They're in what? Brackets. Let's go and calculate the depreciation. So this is how we're going to get our depreciation. So our depreciation, we're gonna look for the difference of accumulated depreciation. Ne? We're gonna look for difference of the accumulated depreciations. Ne? So we're gonna start with what? We're gonna start with the vehicles. Ne? Let's start with the vehicles. So this is our vehicles. So this is our vehicles. Ne? This is our vehicles. This is 2021, meaning it's at the end, and then this is at the beginning. At the end, at the beginning. So our depreciation, our accumulated depreciation, we have at the beginning, we have what? We have 366,000, and then at the end we have what? We have 498,000. Ne? So we have what? At the beginning. At the beginning we have 498,000. We're gonna write it here, 498,000, and then we're gonna have what? Accumulated depreciation at the end, which is what? Which is 366,000. And then you're gonna look for difference, you know? So when you get your difference is going to give you what? 498,000 minus 366,000. It gives you 132,000. Ne? This is what you're looking for. You're looking for the difference for 2020 and 2021. The difference is the depreciation. Same as what? Same as equipment. So let's check the equipment. The equipment, this is the equipment though. So the equipment is what? The equipment is we are focusing on the accumulated depreciation on this column. So the equipment, we have what? We have 267,500, and then we also have what? 772,500. Ne? So let's key. So accumulated depreciation at the beginning is what? It's 172,500. At the end is what? Is what is it? It's 267,000. 267,500. And then you're gonna look for difference. So the difference is what? Is 95,000. It's 95,000. Ne? This is the depreciation that you're looking for. So we're going to add three things. Ne? When it comes to depreciation, we're going to add three things. We're gonna get what? We're going to add what? Depreciation for vehicle, depreciation for vehicle, plus depreciation for equipment, and what? Plus accumulated depreciation for assets sold. Ne? assets sold can be what? Can be vehicle or equipment. So this is what we're going to add. Ne? On this one, we're going to add the depreciation for vehicle, the depreciation for equipment, as well as what? Accumulated depreciation for the assets sold. Let's go and see if we have an asset that we sold. If you can check here, ne? Down here, if you can check here, they said to you that a vehicle has been sold on the last day of June at the end of our financial period for 132,000. The cost price of this vehicle was 227,500 and the net carrying value amounted to 120,000. So how are you going to get it? You're gonna say cost price again minus carrying value is going to give you what? Accumulated depreciation. This is what you are looking for. Ne? The cost price is what? The cost price is 227,500. This is the cost price. This is the cost price. Ne? But the cost price of this vehicle was 227,500. And then the net carrying value amounted to 120,000. You're going to say minus 120,000. Then we're going to get our accumulated depreciation. We're going to get our accumulated depreciation. So our accumulated depreciation, when you punch it on a calculator, is 107,500. 500. Ne? So let's add this whole thing. As I've said, ne? Depreciation for vehicle is how much? 132,000. 132,000 plus depreciation for the equipment is 95,000. 95,000. And then plus accumulated depreciation of the assets sold, ne? Which is 107,000. 107,500. Ne? So when you add them, they must give you 334,500. So this is your what? This is your depreciation. Let's go and key it. Ne? Let's go and key it. So here you're just gonna look for difference of the accumulated depreciations for the assets, which is vehicle and equipment. And then you're gonna look for accumulated depreciation of the vehicle sold, and then you add them. Ne? You add the accumulated depreciation as well as two depreciations. Ne? So let's go and record it. So when we record our accumulated depreciation, don't forget that this is an expense. It won't be in the brackets. Ne? It won't be in the brackets. This is a depreciation. So the profit on vehicle, we're going to get the profit on the vehicle here because of what? Because of our selling price is high. Ne? So we have, if your selling price must always be higher than your carrying value in order to get what? Your profit. Ne? If your selling price is more than your carrying value, you will need to get what? Your profit. So if your selling price is less than carrying value, you have what? Loss. So your selling price must be greater than your carrying value to get what? Profit. And then selling price must be less than carrying value in order to get what? Loss. So if you want to know this thing, just know that your selling price must always be what? High. Your selling price must always be high to get what? To get your profit. Ne? Tšhelete o rekishang ka yona e swanetše phela e ba ntši gore o kgone go kry profit. So now the amount that we sold this vehicle, the selling price is 132,000. This is the selling price, and then this is our carrying value. Carrying value amounted to 120,000. So you can see where your selling price is high. As I've said, ne? The selling price must always be higher than your carrying value. It must be higher than your carrying value in order to get what? Profit. Then you're gonna look for the difference, 132,000 minus 120,000. So when you get the difference here is what? It's 12,000. This is the profit, ne? This is profit, 12,000. So since well as the profit, it must be in what? In brackets. In brackets. Then we're gonna go to inventory at the beginning. When we go to our inventory at the beginning, we're gonna get our inventory on our financial position and statement of the financial position. So this is our statement of the financial position. So this is our inventory. So inventory at the beginning is 181,000. We key 181,000. And then inventory at the end is 244,000. It must be in the brackets. And then trade payable. This is our trade payable. This is our trade payable. So our trade payable at the beginning is 112,000. 112,000 must be in the brackets. And then trade payable at the end. Trade payable at the end must be 140,000. 140,000. Ne? So when we say 3,816,500 plus 1,200 plus 166,500 minus 2,250 plus 334,500 minus 12,000 plus 181,000 minus 224,000 minus 112,000 plus 140,000 must give you 3,363,550. So this is your final amount, ne? This is your final amount of your cash paid to suppliers. So that's how you're going to do your cash received from your customers, as well as what is cash paid to your suppliers.